Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. Our interviewed guest is entrepreneurial investor Reggie Middleton. He's with the boombustblog.com, and he has called a lot of big market moves. He foresaw the Bear Stearns calamity. He saw the Lehman Brothers collapse, the financial calamity of 2008, the housing crisis. And Mr. Middleton is on today with us to tell us what he sees going on. And let's start, Mr. Middleton, in Europe.
Okay, well, Europe is the quintessential example of too many chiefs and not enough Indians. You have the EU project and the EMU project, where you have roughly 17 some odd nations of various laws, cultures, languages, financial systems, banking systems, and cultures. And what the project attempted to do was they tried to recreate the United States, basically by making a united countries, a United States of Europe. It was a flawed concept from the beginning. Number one, because it was idealistic, and number two, because I'm assuming, this assumption of course, the creators didn't study the history. The United States is an economic, political, and militaristic power, but it took roughly 250, 300 years, a civil war which decimated the male population. You know, the definition of decimate is to take 10% of the population out, and it didn't come easily. So Europe wants to do it in, 20 years without the loss of the male population, and I just don't think it's happening. And if you could take a look at the news and the banking system falling apart, the budget constraints that are totally busted, and the general joke that is supposed to be the political machine in Europe, you can see where this was very much conceived. The results of this busted experiment is a significant amount of debt piled upon depreciating assets, which has dwindled and in most cases eliminated the equity, the economic capital that is the lifeblood of Europe and of any country, household, person, or corporation.
You know, they tell us that they've got a deal, and the details are sketchy, and they don't really have a lot of detail. You know, Angela Merkel said they'd never have a common bond, yet they're now starting to bail out Spain. Are the problems starting to be behind Europe, or are there still giant problems facing Europe with this deal? Do they really have a fix or not?
Well, there are several ways to look at it. I'm not going to use any financial jargon, but it's common sense. This was the 19th summit since 2009, since they tried to fix this. The 19th one. The previous 18 didn't work at all. So number 19, of course, this time is different, right? The problem is they're not trying to fix the problem, because the problem is anathema. Even admitting that the problem exists is anathema. And the problem is you have mass insolvencies. You have insolvencies in the banking system. The quasi-sovereign states, and I call it quasi-sovereign because they're not truly sovereign since they don't have full autonomy. They have partial autonomy, but they have to bend towards Germany and France and the ECB for the ability to have their own currency, which they cannot because they share currency with 17 other states, of which only one state truly has sovereign powers, and that would be Germany. And of course, I'm getting sidetracked. So now that the banking system was busted, much of Europe is truly a socialist state. So when the private sector goes down, instead of letting it go down, the state goes in and bail out the private sector. The banking industry is actually multiples of the size of the actual states in which the banks are domiciled. So France or Germany or any other major countries, or the smaller countries, usually don't have the economic firepower to bail out the banking system, because the sovereign state is that big, the banking system is that big. You can't have a creature this big consuming a creature that big and survive.
So what you're saying is that really this is a banking insolvency crisis. The banks are insolvent over there, and aren't they just really, with all this jargon that they're trying to do, buying these euro bonds, aren't they just pumping money in printed money into insolvent banks? Or am I wrong?
Yeah, well, the banks are insolvent. Now the states are insolvent since they ate the banks. But when the term printing money is very misleading, to the layperson. I'll give you an example. And again, very simple. You have a pie, right? This big. And you cut the pie in 10 pieces. So the 10 slices of the pie. Okay, when you print money, right, you're not getting more pie. You're taking the pie and you take the 10 slices and you cut it into 20 slices. You have one more pie, you simply have 20 more slices.
You're just debasing the pie.
Right, you slice the pie into 40 slices. So what they're doing is they're slicing more bits of the pie, but what they need is more pie. You're hungry people. You don't feed any more people by slicing the pie more and more. You just make some smaller slices. What they need is they need more economic capital. They need more money, right? Not more euro pieces of paper, but they need actual more value.
They need what they call growth. They need exports. They need money coming in, right? But they're not getting that. A lot of these countries are in recession, right?
Recession, quasi-depression, enter depression. I doubt very seriously if Greece is going to avoid depression. It's probably in depression now. Of course, you don't know it until after the fact. But Greece is has a significant problem. And the issue is, everybody picks on Greece, but the issues that are plaguing Greece, for the most part, are the same issues that are going to plague much of the EU. And that is, they have dwindling economic growth, they have bulging debt, and they have very little assets of which to fall back on, relatively.
Well, I guess that the gold market and the oil market last week on Friday, gold was up 45, 46 bucks. Oil was up $7 a barrel. Is that really a reflection of, they're slicing that pie up. They're, quote unquote, printing money electronically. And I guess, is that what caused that stuff to take a moonshot?
Well, day-to-day fluctuations you have to be careful of. If you print money, you create the risk of inflation, which has historically driven up the prices of commodities. But you have to look at the flip side. If you have several nations in recession and depression, people aren't going to go out and buy 3,000 SUVs, per family and drive around all day. So the demand for oil will dwindle simply because people don't have the money to pay for it. Supply and demand will limit the price of oil. You will get spikes, which will cause shocks in the system like they did in 2008, which caused oil to spike up to 140, 150 dollars a barrel. But it can't stay there because there's nobody to buy it. There's no demand for it, and it's expensive to begin with.
Okay, so you've had some big predictions. You said that Bear Stearns was insolvent. They were. You said Lehman Brothers was in trouble. They were, caused a financial meltdown. You predicted that also. You also made some big calls in the housing market, said it was a bubble, said it was no way it could keep going. In effect, I'm paraphrasing. What's going to go on now with Europe? One of the big hedge fund managers, Ray Dalio, said he kind of at the beginning of this year, the end of last year, said he expected another kind of a collapse at the end of 12 or the beginning of 13. What's your prediction for what's going to happen in the world economy?
Well, the collapse in Europe is absolutely unavoidable. Like I said, you have 10 people to feed, you have one pie, so instead of baking more pies, you're cutting that one pie into different slices. No matter which way you do it, it doesn't matter how you cut the pie, what kind of knife you use, or what kind of political meaning you have around the pie, that one pie is not going to feed 10 people. So a economic collapse in Europe is a foregone conclusion. How it's going to play out, and the paths of contagion are the variables.
You're saying that we're going to have an economic collapse in Europe, no doubt.
Yeah, that's a constant. That's like if you throw a rock up.
So my next question is when?
Excuse me?
When do you think it'll collapse?
See, timing is difficult because there are machinations in place to prevent the collapse. I won't say prevent it, to push the collapse forward in time.
Which is print money, bail out the banks, slice that pie up.
Yeah. Now, the printing money works until it doesn't work. The problem with printing money is eventually you'll have a significant run on the banks or on the nations. And the runs on the banks are generally, in this modern day and age, the impetus is usually caused by counterparties. Most people think the run on the banks are initiated by individuals or corporations that want to pull their money out of the banking system, which is the case. And you see that right now in Greece, Italy, Spain, you see significant outflows. But the state can put devices in place to stem that run. What they cannot stem, or what it is I think many of the leaders in Europe just simply don't understand, is that the modern day bank run is initiated by counterparties to the bank, who either demand real collateral, which there is none, or more of the phony collateral, or simply will not do business with that entity and then pull the support as a counterparty. That type of run, there is no protection from the government and from the powers that the regulatory powers that be in these individual entities in the political parties. And I don't know if it's that they don't understand how the modern day bank run occurs, or if they're simply incapable of doing anything about it. I mean, that's how Bear Stearns collapsed. Bear Stearns didn't collapse because, Uncle,
people lined up outside.
Excuse me? Yeah.
You don't see the 1930s people lined up. That's not what you're saying. You're saying that now this is electronic, this is high tech, this is credit default swaps, this is people demanding their collateral, this is big institutions. So it can happen, boom, just like that.
Yeah, Bear Stearns happened over the weekend. They had their margin calls and collateral runs over the weekend. Lehman as well. Basically their banking counterparties say, we no longer trust you. Either we will not do business, or you have to put up XYZ more collateral, which of course the entity didn't have. If they did have it, they wouldn't get a collateral call in the first place. At least the fear of a collateral call.
And you're saying on a bigger scale, this is going to happen to Europe.
Yeah, well, you have to understand, Europe is insolvent, in general. If you look at the strongest state that everybody looks to, which is Germany, to bail out Europe, what makes people think that Germany is immune to everything that's going on in Europe? They have negative growth economically. They're a net export nation, and all their major export partners are either in recession or approaching recession. That's the U.S., the EU, and Asia, approaching economic hard landing or in an outright depression. So they're going down. What makes you think they can save the rest of the EU?
So if Europe goes down, what happens to America?
You'll have capital flight in the beginning. If Europe goes down, the people who have capital want to put it someplace safe. Safe is relative. People ask, is skydiving without a parachute safe? Well, it's safe relative to, playing Russian roulette with 6 bullets in your gun. So, something may seem dangerous, but it all depends on what you're comparing it to. So, if you have a bust in Europe, you have capital flights to the U.S. After the capital flights to the U.S., you have most likely have the realization that the U.S. has very similar problems, or the same problems that the EU had. The difference is the U.S. has true sovereignty, number one. We have our own printing press with only one mouth to feed and only one person or one entity to answer to. We also have a very strong military, and at the end of the day, it's usually the strongest military that tends to call the shots. And we do have a stronger economic framework than the EU in general. But, of course, we have very similar problems as well. Excessive debt. We have to keep pulling a rug over everybody's eyes in terms of non-performing assets in the banking system, insolvent banks, etc. So, I feel that the crash of 2008 has never finished because of the kicking the can down the road mentality of solving problems.
So this is just an extension of the crash of 2008.
Right, simply have to finish it. You'll have capital flight. You'll probably have treasuries go negative again. Treasury yields go negative, where people actually pay the government to lend the government money. And that's simply because they're not looking for a yield or return on their capital. They're more concerned about the return of their capital. And so in doing that, you have the quintessential bubble, where I pay you, 0.5% to give you my money, which is outrageous. But when you have that, that's the writings on the wall. I mean, that's been the case in the U.S. for a while. Germany now has very low rates, and if I'm not mistaken, even German bond rates went negative once or twice.
So, last year, Wall Street Journal reported that the Fed bought 61% of the treasuries. I mean, aren't we using that sovereignty and printing press to slice that pie up and debase the dollar?
Because it's even worse. We are slicing the pie up, and then we're eating the pie and throwing it back up, saying, hey, you have more pie to give everybody. If we don't have any more pie, we ate it and threw it back up, and then we ate it again, and we're saying, look all the demand we have for this pie. Okay? It's a bunch of vomit in a pie can,
So if everybody's slicing these pies, are you a gold investor? Are you a commodities investor? Are you, where are you putting money? Where are you just on the sidelines?
Well, I'm on the sidelines in cash, and I use certain my proprietary trades based upon my research that capitalized against very strong positive and negative moves. I guess you call them Armageddon trades. And they did very, very well in 2007, 2008, the first part of 2009.
Describe an Armageddon trade.
Yeah, excuse me?
Can you give me an example of an Armageddon trade?
Basically, buying something like an option, a put that is way out of the money with significant time value in it. Assuming that, let's say we assume, I give examples that actually worked in 2008, 2009. I assume that Bear Stearns, when it was trading at, I think about 130, between 130 and $90 a share, I assume that Bear Stearns would break $20 a share. Okay,
oh, boy.
Puts, with a year of time value on it, with strike prices between $10 and $50 a share. I bought them for pennies, literally pennies per contract. I bought many contracts, and when Bear Stearns went bust, contracts that were going for 30 cents, but now being sold for $30, $40, $50 a contract. So 200 or 300 contracts you bought at 50 cents, you could sell at $50 as well. Now, statistically, there's a very slim chance of that, but this is not a statistical trade. It's a fundamental trade. Basically, I took a look at the corporation. I saw there was no equity there, no value. It had negative equity, but the market was trading as if it was worth $90 per share of equity, and it's worth less than zero. And that was a trade.
So where do you think, big picture, we're going to have Mad Max again? We're going to have a Mad Max type scenario? We're going to have that kind of a collapse? Because we never really had that, knuckle grinding, fall on the face collapse. I mean, they stopped it basically with $16 trillion, according to, the Government Accounting Office. They pumped out, TARP, the stimulus package, the Fed buying toxic debt. With the next crash, I mean, are we able to do all that again?
I don't think the political willpower is there. And if it was there, you have to take a look at whether it's worth it. We didn't solve the problem. We pulled sheet covers over the problem, and that would work. I would actually endorse that if you can provide the growth to grow the banking system in the country out of the hole. I have no problem with punching everybody in the eyes so they can't see that we're in the hole, if we're able to come out of the hole before the people get their eyesight back. The problem is there's not enough economic growth to truly go out of the hole. If you take a look at the issues of 2012 and you take a look at the issues of 2008 that caused the problem, what is the difference? Really, what is the difference between now and then? We still have a significantly overvalued and busted housing market. We still have banks that are not willing to lend freely, except for unusual underwriting practices. We still have stagnant economic growth, if not negative economic growth. We still have very high unemployment. And we have a macro situation around the world, which is much, much worse now than it was back then, when the U.S. was the one exporting economic contagion. Now you have Asia that's ready to export economic contagion. China, the economic growth story of miracle of the world, basically was a nation that lied about its growth statistically and told its banks to supercharge loans, and as a result, you have a bunch of bad loans with a bunch of non-performing assets in the banking system, which is exactly what the U.S. had, and you have to pay the piper with that. And just a year or two ago, the rumor was that China will pull the world out of the potential for recession. Germany will allegedly bail out the entire EU. Germany cannot.
That's not going to happen.
Yeah, there are no miracles. If you wait for a miracle, you're going to be upset. There's that old, I think it was E.F. Hutton, I can't remember, commercial, where the broker said, we make money the old-fashioned way, we earn it. Well, it seems like, nobody wants to earn it anymore. Everybody wants to play a financial engineering game or put a political, game somehow, create something out of nothing, or take a problem and call it a solution without actually solving it. And it gets you nowhere.
So you're saying we are worse off now than we were in 2008?
We're very similar, except for the global macro situation is much worse off. So if you put everything together, we're worse off. The positive is you have devices in the U.S., right, which are designed to pump liquidity into the banking system. Okay, you have devices in Europe that they're trying to put devices to pump liquidity into the banking system in Europe. But that's the solution searching for a problem. The problem there is a liquidity problem in the banking system, but the liquidity problem is there because everybody's concerned that there's insolvency. So when it's insolvency, you don't have a lot of bids for assets because people want to make sure that what they're bidding on is actually what it is that they see versus a puff of smoke or a game. And that's what the liquidity meant. And the liquidity is gone because of the fear of insolvency. So instead of pumping liquidity into the system, right, we need to attack the actual problem, which is the fear of insolvency. And the fear of insolvency is not paranoia, in my opinion, but is actual reality analysis. You know, you have entities that either cannot make their debt service, which makes them insolvent from an income perspective, or that have more debt on their balance sheets than assets, which makes them insolvent from a balance sheet perspective.
You know, when I was setting this interview up, I asked you about Europe, and your short answer, I said, what do you think about Europe? And you said, it's just smoke and mirrors, man. Smoke and mirrors.
Smoke and mirrors. The 19th summit with the first solution yet to come.
Yeah, when you say a solution, shouldn't some of these banks go into receivership, mark down their bad debts, and go into bankruptcy? Isn't that the answer? Some of these guys just have to go bankrupt?
Yeah, well, they should. You know, bankruptcy is, a U.S. concept. It's a legal term, but they should basically go out of business or, like I said, go into receivership. But if you do that, it sets off a chain reaction because when you do that, you're forced to, when you have to sell these assets, you're forced to create a real market price for them. And so everybody else that has similar assets are forced not, they can't say, that these bonds are worth 100% on the dollar. When, their neighbor, went bankrupt and was forced to sell them for 18 cents on the dollar. So now how do you perpetuate the lie? You can hold it on sheet for 100 cents on the dollar, but everybody looks at it and says, honestly, it really looks like you're 82 cents overpriced.
What you're describing is systemic failure. I mean, what they're fighting is a massive insolvency, the debts that are worth, 18, 20, 50 cents on the dollar, whatever they are, high leverage, they can't take the hit, and it looks like what you're describing is we're going to have a giant crash, a giant insolvency blowout before this is all over. Am I wrong?
No, I mean, you need that. That's the only way you're going to get the prosperity. In the U.S. in 2008, 2007, Hank Paulson came up and said the end of the world is coming, etc. The end of the world is not coming. If you're a bank CEO,
yeah.
the end of your pension may be coming, but that's not the end of the world. Listen, for the last 2,000 years, banks have been going bust every day. The sun came up the following day every time, 2,000 years straight. Let the banks go. The sun will probably rise tomorrow. Trust me. If it doesn't, we probably won't have another Scott interview, will we? But, I put my money on the sun rising tomorrow. And once you have the insolvent entities go bust, you have true economic activity. Because you have new entrepreneurial blood, you have new activity, you have new capital go in, and it attempts to, and it will, do business anew. After the phoenix, crashes and burns to their ashes, out of the ashes rises a new vibrant animal. And that's how capitalism works. Because true capitalism has success, which is born of failure, and has failure, which is born of success. But if you try and prevent failure, you're not going to get success. They're two sides of the same coin.
And that's what they're doing. They are preventing failure. They are preventing failure.
No, you're not preventing failure because failure is already there. You're refusing to recognize failure.
Okay, and when do you think this phoenix, and then my last question, when do you think this phoenix is going to crash?
Well, the phoenix has been crashing. The problem is you have a bunch of politicians and regulators and central banking bodies who are basically telling everybody Phoenix hasn't crashed. They have hands over certain observers' eyes and rules and regulations that said, even if Phoenix crashed and has 2 broken wings, a broken leg, and burnt feathers, we still recognize it as a flying phoenix. If you recognize a flying phoenix, then everybody can do business with it as a flying phoenix. The full crash won't happen until that last leg breaks, and the phoenix simply can't be recognized as anything but a dead, burnt bird, regardless of what you call it. So we've been kicking the can. It's been 4 years now. I've been kicking the can down the road. I know true recompense is coming soon simply because no matter how skilled you are kicking the can down the road, you need road to do that. And it looks like we're coming to the end of the road. In the EU, you know, still have significant issues in Asia, significant issues in the U.S., significant issues in Europe. But Europe's role is coming to a to a dead end very, very soon.
And if there's war in the Middle East, if the Iranians close down the Strait of Hormuz like they're threatening to do, if these new sanctions go in, or if somebody makes a mistake, if one country attacks another, Israel to Iran, Iran to Israel, what happens then? Does the Phoenix catch on fire and turn into ash immediately?
You know, it's hard to tell. You know, that there are a lot of variables there. It's hard to tell. I attempt to map the variables out. I have a subscription service, and, you know, I've given my ideas, my opinions, and my analysis to subscribers. But, you know, at the end of the day, you know, it's tantamount to predicting the future. The militaristic conflict is almost assured, and you have to look at it, you know, from my perspective. The new military conflict in this day and age, 2012, is not just guns and missiles, but you have things such as cyber attacks, which we've been at war with China for a while, which nobody seems to want to admit. You have covert operations. So it is going on. With that being said, conflict will probably occur within Western, Northern, and Southern Europe as well. You have political conflict right on the edge of combustion, right there. And the reason is because you have several conflicting interests. And when you have conflicting interests, eventually, you know, interests go into conflict. Now, I'm not going to say they're going to actually send planes after each other, but then again, I wouldn't rule it out either. But you are going to have some type of conflict. Old-fashioned militaristic conflict in the Middle East will send a spark, you know, that can set things off. But, you know, there's so many variables. The only thing I think is I can actually guarantee as a constant would be economic collapse and the potential for rebirth in the EU area.
Economic collapse is the only constant you see.
Right, and rebirth. You know, it's not the end of the world. I'm not a doom and gloomer, okay? But in order to get the rapid economic growth, you have to flush the trash out of the system. That's why the EU has been growing so slow. The trash has never been flushed out. The same thing with the U.S. Okay, it's never been flushed out. So
Reggie Middleton, thank you for being on USAWatchdog.com. You are with the blog, the Boom Bust blog.com. You've called a lot of big ones. Thank you for joining us here today on USAWatchdog.com.
You're very welcome.